Welcome to the Pump and Dump channel for another video. This time looking at the Dow Jones oil and gas. So the Dow Jones, it's kind of formed this head and shoulders that I had thought it would, and that suggests we do go down to 24,000, maybe even to 23,000 on the maximum downside. But as long as we tag along this trend line here, the momentum will build for us to break up to the upside when the next, let's say, stimulus packages come into place. We have, going into the end of July, the PPP program, or whatever it's called in the US, is running out of money. So people who are still unemployed, they will not get any money after that unless they extend it. And I think the sentiment around central banks doing all the QE and the government putting like $1 trillion stimulus packages together and giving the average person, the citizens, almost nothing of it. I think that is going to kind of boil over if they don't give them any more money. So I think the politicians will have to keep giving them money. And then of course we do have the infrastructure bill that or stimulus package that Trump wants to bring in, that everyone is talking about now. As we go down, as everything sells off, they talk about this is coming. Keep your eyes on the long term. And yeah, as things deteriorate, the hope dies last, and the hope is starting to die. It's not quite there yet. I think the news has not caught on yet to everyone. We have here, let's bring this up. The coronavirus is making its second wave, let's call, of shutdowns, let's call it, because it's not necessarily the coronavirus that's the problem. Here's the government action that is creating lots of uncertainty around everything. So New York, New Jersey and Connecticut impose 14-day quarantine on travelers from coronavirus hotspot states. So to me that sounds like, let's say, Florida is a hotspot state, because let's say in Tallahassee, the capital, they have a lot of coronavirus cases relative to the people who have been tested, and therefore, it's designated as a coronavirus hotspot state. All this kind of doesn't make sense, because, like, let's say you're from Miami, and Miami is not a hotspot area. Why would you be denied to fly in unless you subject yourself to 14-day quarantine? And the 14-day quarantine, upon arrival, I guess this is. So, when you arrive there, you obviously have to go through the airport, interact with the staff, have them tap you down, touch you and everything, and you might spread it to them, you might spread it to people who are standing around you. You don't have to wear a mask, maybe, I guess, on the in the airport. I don't know. I mean, once you get out of the airport, you can take it off if you don't want to wear it, and you might interact with people on your way to your quarantine destination. So there's a lot of things here that don't make any sense with this whole thing, but it's kind of like some states just want to flare up this anxiety about the coronavirus again, and get people to feel all nervous, and get people who have bought in recently with the FOMO to reconsider their actions and take a 20-30% loss on whatever they bought. And that's just the way it is. So the situation dictates that the charts could complete this head and shoulders with another move down, and with some positive momentum coming with the following things, we could break up again to here or even beyond. Oil price is similar. It's not looking good. We kind of peaked in terms of sentiment here on the 8th of June. This is kind of when companies were like trading at the max premium that I would give them, and some companies are not so good at fair value, or that are not well understood at fair value. And then we retraced, we broke out of this channel here. Of course, RSI has gotten pretty overbought here, and then you can see how the RSI is curling over as we do this second attempt to fill the gap up to this $42 area. This is kind of the long-term price I think is reasonable. It's based not only on these 4 connector points here that you see where we kind of bounced off previously to the upside, and where we broke through and broke above here as well. it's kind of also, founded on what some of the economics look like for some of the oil and gas producers in the US. At what prices can they, how can they make reasonable profits and survive in the long term? It's kind of centering around $42. So I do think that, in the long term, we're going to be between 35 and 45, and 50 and $60 could be seen as the peaks or the cycle peaks, maybe just 55, and that might be in like a year or 2 or 3 years time from now. So not looking good. I think it goes down to 33, and depending on how the RSI evolves as we go down here, that could form a base for the oil price kind of to move higher again and touch again this 42, maybe bounce off and then go through. It's all about when the economy reopening and the getting back to normal story kind of commences. That's kind of when we will be there. Now with natural gas, it's similar. It's not looking good. The bear flag here that was broken out to the downside, and where we retraced and we kind of bounced off again this resistance here, that is kind of taking us down here, and it's looking like we're going to fall below this support, so we're probably going down to the 153 level again, 150 maybe even, just to get the round number. And there is a case to be made that we do break below, maybe to 130, and then it stays here for a week or two, and then we come right back up to 150 and start working our way up here on the continuous contract. So we still have August ahead of us, which I think will be the low for the year for natural gas prices, and a multi-year low. If you just look back, there's nothing there anywhere near as bad as where we are now. I mean, if you like extend it here, you can kind of like see the downward trajectory in the chart. So this is kind of where it's at. Natural gas price is looking bearish. RSI is looking bearish. We probably do drop down here to 30, and from 30 we might like rebound and move higher at some point once we regain some traction, but it's not looking good. So to the portfolio for today, so I've added a few columns: current price and 1-year target price, updating them. I'll do that whenever I post a video, because these numbers will fluctuate over time, and you'll see that maybe you'll be like, oh, you thought for CNX that 935 was reasonable and now it's 7 is the target, and maybe maybe I don't know, let's say for Range Resource I thought it was 11, and for 1144, and then I change it to 13 when it's like at 12, and then you'd be like, well, I'm just making it up as I go. But you'll see that the system, it has some logic to it. I also added here to reflect the profit and loss in the near term. So African Gold Group, nothing has changed here. The target is unchanged. I added also these yellow boxes where I think that there can be improvement in the share price coming from the valuation, where the market just realizes that the stock is undervalued because it's mispriced, like in the case of Range Resources and Noble Energy that I will talk about today. Same with Alliance Resource Partners and DHT and African Gold Group. So also added sentiment for the sector, the way I see it, not the markets. Bullish on gold, bullish on natural gas liquids. I'm bullish on Range Resources still. You can see the current price is down substantially from the purchase price, but I'm looking at the 1-year target versus an updated 1-year target, and I see it just widening, and I don't see why it should be trading at 560. It makes no sense to me, and therefore I need to assume the market is wrong, because I see how the market is pricing it, and that's the way it is. Even if I do price the natural gas liquids as WTI with a discount, it still would be higher than 560. This is just the way it is. With DHT holding, I could lower the target price to 7, but I think because we're in the low season and here spot and charter rates are coming off, it's normal to assume that that the charter rates are not necessarily reflective of the current state of the market, and if oil production resumes and needs to be transported all over the place, we could see another spike up in the end because of the floating storage situation, where a lot of VLCCs and other vessels are tied up in 1-year deals or 6-month deals that are kind of restricting how fast tankers can be mobilized for transporting oil. So that could have some pressure effect on the VLCC rates that could benefit them and get them back to 45,000. But in the near term, it does look like they're going down. And with DHT, I remember this in January, the charter rates, they fell to like 30,000, and the stock price, it kind of, I think it bottomed around $4 and change, and then it rebounded back to 8 something. So I mean, the charter rates are not necessarily always going to reflect exactly what the valuation is for the stock. So with CNX here, bearish, and with DHT, I didn't mention this, but I'm bearish on the VLCC rate, so there's potential downward pressure on the share price, and it's kind of reflected in the closing price of today. CNX here is bearish because of the natural gas price. I showed the chart, and there are some fundamentals at work. A lot of oil and gas companies who can switch from oil into gas, they did so in April and May if they were unhedged for their oil production. I'm thinking of companies like Continental Resources, or probably also Chevron, who don't hedge themselves. So these two companies, as an example, they could be seen as shifting out of oil production because the prices were too low and the demand was not there, and focusing more on natural gas because the prices for natural gas were still strong, and take advantage of that. And it doesn't necessarily mean producing into the spot market, but it also means like looking at contracting out and selling it into future months. So that's there's some aspect to think about as to why the situation here is deteriorating for the natural gas price, and the share price is going down with it. It's normal, but I think if you look at the 1-year targets, come down substantially, but so has the share price. The share price has gone down about 90 cents or 85 cents, and the 1-year target has gone down $1.45. So you can see how the stock price, it has gone down less than my target price. So you can see here that the company, the way I see it, like it's performing in line with what I would expect, where the stock holds up better than it should because of the valuation, not necessarily accounting for uncertainties going into the future, and also certainties of cash flow that the company has. And it's maybe a bit difficult to explain that, but like I've mentioned this before, they're like hedged for this year, next year, and the year after for a large part of their production, so they don't care what the natural gas price is right now. All they do is they look at the outlook, and in 2 or 3 years time, when when they're on lower volumes of hedged production, I mean, they could of course sign more production contracts for the following years, but like when they move on to fewer contracts or hedges, there is this situation where the macro can improve, where lots of oil and gas producers are shutting in wells or they're going out of business, and at that point in time, it's the question of what is driving the the market for the price, and if there is not enough supply coming on to replace the supply that is falling off, then the natural gas price will experience a surge, and it's of course going down at this point in time, but the stock will probably be able to regain 981 in the future for sure. Maybe not in the near term, but in the future, pretty definitively, I do think that will happen. Safe Bulkers looking a bit down. I mean, this is a stock that kind of currently confirms that we're in a bearish mode. The price is down 5 cents at the close. The valuation has not changed whatsoever. The spot rates continue to climb for dry bulker vessels, and that is kind of not being reflected in the share price yet. So here is a case of the stock should be a lot higher, but it's not, because we're in a bearish mode and people are not willing to put money to work into the market. They're kind of like selling off things. You can see that with oil and gas producers. So here I feel very bullish, but the market is not in agreement, and therefore I think this is a high conviction play from my part. Next to the two additions of the day, so bearish on Noble Energy, but I'm still going to buy it. Bearish because of the macro, the oil price and the natural gas price are kind of struggling and going down, and that should put some pressure onto the share price of Noble Energy. But the intrinsic value that I have for it is about $14, which kind of accounts for the what I would call like this is kind of like with Range Resources, where something is not priced correctly. I think I've talked about this before, so I'm not going to get into it in detail, but basically the Israeli gas production is, in my opinion, not being priced correctly. So it's kind of like going down based on this idea that natural gas prices in Europe are weak, and in Israel they probably then would also be weak if you kind of substitute one for the other, but they're not the same the way I see it. So I think here there is an upside there intrinsically to the stock, but the price, it keeps dropping because we're in a bearish mode, and we will stabilize at one point and then we'll start moving up. And yeah, that's kind of how it is. Next one, Alliance Resource Partners. I have mentioned them once or twice on my channel. Not gone into them in depth, but here's the situation, how I see it. So in terms of the upside and the downside, this is a coal mining producer, coal mines they have for the most part of their business. They also have some oil and gas royalties on land that seems to be decent from what I've seen, and the market does not like this company whatsoever. I look at this stock, and you can see this in the valuation over time here, how I see this progressing. The market is not giving them any credit. They will at most pay about half intrinsic value, so that's the fair market value that they are willing to give this company, because of a lot of uncertainty, and the businesses, they're not very clear about some aspects that would be necessary to be able to make a very informed decision about, or conclusion about, the value of their business. But when you're looking at it here, that is kind of my target. There is cause to be optimistic. If I look at the coal prices, they are rising for Central Appalachian coal. You can see at the top one, this is kind of like the, how should I say, the premier grade, I would say, because of its location. I think it's like probably, like if you look at other ones, you could make a case for, like this Uinta Basin coal being better than Powder River Basin coal because of the higher BTO with the same sulfur. But if you look at it compared to Illinois Basin has more sulfur and it's trading higher. And I think the reason here for Central Appalachian and Illinois Basin and Northern Appalachian to trade higher, despite the unfavorable dynamics around sulfur and slightly better BTU, is that is proximity to the market where it's burnt. So I look at Central Appalachian as the premier grade with low sulfur, high BTU, and if you think about it in that sense, you come to a conclusion that this one is the strongest, it's moving first, and these ones are going sideways. But once this starts making moves up, like rapid moves up, then you could see these ones move up strongly too. And that is kind of the thesis behind buying Alliance Resource Partners, is that number one, the stock is completely undervalued. I think 10 here is closer to an intrinsic value, assuming stability over the long term for its coal and oil and gas business, and valuing the company based upon like the full value of the reserves of the oil and gas mineral segment plus the coal business, I kind of get to $13.28. So I kind of see this as the path over 1 to 2, 3 years of getting from where we are now up to here. But on the flip side, I do see a scenario where we could drop to $2.50. So the downside here is 90 cents and the upside is $10 approximately over a 3-year period. So let's say it's about 26, 7, 8% downside. Yeah, 26% downside versus 300% upside, let's say. So this is kind of how I see it. So this is kind of the rationale for buying these two today. 1,000 each, that's what was left over. Cash is now at 0. I mean, I could make a case for putting 2,000 into Noble Energy, but I'm bearish on the oil segment, so I feel like 1,000 is sufficient to get this, well, almost 50% upside to its fair value. And with Alliance Resources, it's how should I say, it's a no-brainer to me, 1,000 here, because there is a high degree of uncertainty what the true value is of the company and how the market will perceive it. And also coal over the very long term has a very weak outlook against natural gas. They just cannot compete, and that is kind of probably what is weighing on the company and why it's undervalued as much as it is. So we will see how this goes. Getting to the profit and loss, I kind of put in, it's not perfect, but it's close enough, so it looks like it's down. Let's put this here divided by the starting point, 10,000. You can see it's down 6.27%. So this is kind of the performance over the week. Of course, you'll look at this and be like, I must be an idiot to lose so much in such a short period of time. But in terms of all the stocks here, I feel no pressure whatsoever. Apart from with CNX, I think that this is something that could go down substantially with a lowering of the 1-year target, where it's maybe not possible to achieve this purchase price in the short to medium term before the 31st of December. Though I think that going into the winter months, we will see how the demand for natural gas is looking like, and what the available, what is the demand versus the available inventory, and that will kind of give us some clarity over the direction of natural gas. Because in terms of how I see it, the in the futures contracts, the 2021 contracts, they are higher than the 2020 contracts, but then the 2022, 23, 24, that kind of is like declining. It's it's going down. So it's kind of a signal that at least to me, that natural gas is in short supply, even though inventories are full. But like the perception, the perception is what really matters here, and the perception is that natural gas is going to be in short supply because all these companies are going to go bankrupt because they cannot make it at these oil and gas prices. So the supply is going to come off unless natural gas stabilizes, I would say, at 175 to $2.25 as a bare minimum to maintain production in the near term, with the declining rate over the long term, and $2.50 to $2.25 is maintaining it long term, and 250 to 275 is a range at which it can slowly grow and increase. And it's not necessarily that it can grow as a whole, but from the areas where it is possible to extract oil and gas, it can grow in those areas. So it can be the situation that a few oil and gas producers, or not necessarily a few, but quite some, go bankrupt, and some of their fields just don't return back to market because the prices don't allow for it. And in that scenario, the natural gas price would have to rise above $3 to incentivize those who can make it to quickly ramp up and produce more, or at least give the bankrupt companies a lifeline so that they can come back into business, refloat their stock, and then continue producing over a few years before they go bankrupt again. So that's kind of how I see it. I mean, natural gas and oil is really interesting at this point in time with all the shale revolution. It just is. It is the way to go. I know a lot of people say that shale doesn't work and it's not economical and all this nonsense, but apart from some shale being uneconomical and some businesses being run poorly, the reality is that in many places it is economical, and therefore it will stay with us. And the investment, or the money, has been going into shale and into the unconventional plays. Well, not all of it, but most of it. Not so much has been going into conventional oil production. And the key here is really like looking at costs, upfront costs, and production costs versus development costs. And the development costs for shale are dropping because of innovation that keeps coming into the space. And from my research, the conventional oil and gas fields, they're kind of more of a like upfront, heavy, capital intensive investments. So you have to put down a lot of money to get these things into production, and once they are in production, the operating costs are relatively low. So the investors who put the money in to get these things working, they don't necessarily see a return on their investment, because the market just looks at the operating cost and they say, well, the other cost, that's some cost, you don't need that money. So you just gave money to us, is what the market is saying always. So anyway, I'm just going to leave it with this last comment. As always, remember, this is not investment advice or recommendations for you to buy or not to buy these stocks. I don't want anyone writing in the comment section that they bought it and they went all in on one name and it went down, and they went, they replicated here and it didn't work out. I mean, the target date is the 31st of December 2020. There's no guarantee that this will give a profit, but I'm fairly certain in terms of the valuations that these stocks do have the potential and a high likelihood of achieving these targets. So if I just look at the sum of this versus the purchase price, I need to exclude African Gold Group because it's a Canadian currency, so I think it was that. So you can see here clearly that the projected return should be about 48%, but I have to of course also adjust it for the amount invested. So here I need to basically just I'll do it here, even though it's not correct, but I need to adjust it for this, and I'm not going to do that in this video. So you know, around 48%, let's say, or 50% should be the theoretical achievement within a year, is kind of where I see the portfolio moving to. And if it doesn't happen, it doesn't happen. I will update things, and if something is not working, I can always substitute it and put something else in. I mean, it wouldn't be a mistake to sell CNX here at 896. The question is just, what do you do with the proceeds from the sale? What do you invest it in? And if you cannot find something else to invest in, you can only go into cash or stay long the course. And you know, I've mentioned this before, that this is maybe the one where I'm the least certain about it achieving its intrinsic value in the near term, but I do think it is possible it will. So I'm going to leave it with that. Remember, it's not investment advice. Recommendations to buy. If you like the content, don't forget to subscribe. Leave questions, comments and opinions in the comment section, and have a good day.